Good day. My name is Rossouw and I'm a portfolio manager with Adviceworks Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworks sees the way forward. This week, China announced that it would allow all Chinese couples to have 3 children instead of the currently allowable 2. This was in response to census findings which included a rapidly aging population and a sharp drop in the fertility rate. China implemented its controversial one-child policy in 1979 when its population surpassed 1 billion people, and replaced it with a two-child policy in 2016 when population growth had slowed markedly. Ironically, this measure is unlikely to have much effect since rising living standards and the high cost of education have resulted in many Chinese no longer wanting to have more than 2 children. By Friday night, 173 million people had been infected with COVID-19 worldwide, and more than 3.7 million people had succumbed to the disease. The United States remained hardest hit, with 34.2 million infections and 612,000 deaths. India, Brazil, France, and Turkey still make up the rest of the top 5, and South Africa is sadly now up to 19th position in terms of the most recorded cases. There was a further decline in new COVID cases this week, down from 3.8 million to 3.2 million, or around 15%. This was largely due to sharp drops in India and the United States, where new infections fell by a third each. The infection rate was flat in Brazil and Argentina, but rose significantly in Colombia, the Philippines, and Thailand. South America and Southeast Asia are now the epicenters of the pandemic, while Europe and North America seem to be gaining the upper hand in the war on COVID. The daily global death toll fell by 10% this week, from more than 27,000 to less than 22,000. Once again, India and the United States led the way with declines of 20 and 29% respectively. Malaysia, Sri Lanka, and the Philippines, on the other hand, suffered increases of between 20 and 50%. Mexico saw an increase of 8% last week, but the number shown here rose by 60% as a result of the government admitting that it had understated fatalities thus far and had decided to restate the numbers. The global drive to achieve population immunity through vaccinations is starting to gain momentum. By Friday night, nearly 2 billion doses of vaccine had been administered worldwide, and just over 1 billion people have now received at least one dose. This equates to nearly 13% of the world's population. China and the United States have administered the most doses, with 723 million and 298 million respectively, with India approaching 220 million. It is estimated that about 250 million Chinese are now fully vaccinated, followed by the United States with 137 million and India with 44 million. Unemployment in the United States is falling and business confidence is at record levels, but not by enough to change the Federal Reserve's dovish interest rate outlook. Inflation is rising in the Eurozone, as is business confidence. Meanwhile, China is doing all it can to massage its currency lower against the dollar in order to keep export prices competitive. For more than a year, America's savings rate has been rising as people received stimulus checks but deferred discretionary spending. Now this benign state of affairs is changing because total income, the light green line, is lower now that government payouts have ended, while total spending, the dotted red line, is steadily rising as the economy is reopening and optimism returns. According to China's recent census, there were only 12 million births in the country last year, which equates to only 0.85% of the population. This was the lowest birth rate since the Great Famine, which followed Mao's so-called Great Leap Forward, as can be seen in the infographic at the top. With an implied fertility rate of only 1.3 children per woman, the Chinese population is aging fast, as can be seen in the bottom infographic, which may well hamper its continued economic progress. The industries which were hardest hit by COVID can be covered by the acronym BEACH, which stands for Bookings, Entertainment, Airlines, Cruise Lines, and Hotels. The restrictions on travel and social gatherings imposed worldwide caused untold damage to these sectors, but with a semblance of normality now returning to many countries, it is expected that the beach industries and the millions of people who work in them will benefit. Equity markets benefited from reassuring noises by the Fed, but the bond market is less sanguine. The dollar weakened on the prospect of continued low interest rates, which contributed to a rise in the oil price. In America, President Biden introduced a number of restrictions on investments in Chinese companies with military and intelligence ties. Amazon is now a big player in streaming entertainment, and Tesla's share price is in reverse gear. Equity markets mostly ended the week higher, with Western bourses all in the green, but Japan and China losing ground. The Biden administration's curbs on investment in Chinese companies with military ties added to the woes of Chinese technology companies already under pressure from their own government. Mumbai Sensex had a strong May despite the COVID flare-up in India, while the FTSE languished. The Sensex has now taken the lead over 1 year from the Russell 2000, while the Nasdaq remains peerless over 3 years. This graph depicts how investor sentiment towards European shares has improved since the beginning of the year. Last year, exchange-traded funds based on Eurozone equities suffered huge outflows as the US market, and particularly technology shares, stole the headlines. Since then, European bourses have outperformed their American counterparts, which has caused attention to shift eastward. In May alone, European-focused ETFs attracted net flows of nearly $5 billion. Based on long-term valuations, European equities are certainly priced more attractively than their American peers. This graph compares the prices of American and European shares to their average earnings over the past 10 years, and American shares, the pink line, were 63% more expensive than European ones, the blue line, at the end of May. Commodity markets produced a mixed bag of results this week. Iron ore came storming back after its sharp fall late last week, and oil and coal kept rising. Copper and cobalt were the week's laggards. Coal and iron ore were the top performers over the past month, while the so-called battery metals brought up the rear. Lithium, oil and coal have fared the best for the year to date, while gold is once again negative after an indifferent week. We remain positive about global equities. Corporate earnings continue to grow in the current low interest rate environment. US price-to-earnings ratios are looking stretched, but equity earnings yields remain more attractive than bond yields. Pan-Europe offers better value, but the most attractive valuations are to be found in Japan and emerging markets, including China. We are, however, keeping an eye on what happens to inflation and interest rates and will react if they take a turn for the worse. For now, we remain underweight global bonds as yields remain unattractive, and if mandated to invest in bonds, we prefer emerging market bonds over those of developed markets. We retain a neutral weighting with regard to global property. Our least favored sectors are retail and office property because e-commerce and work from home could do long-term damage to their profitability. Conversely, these two trends are positive for the industrial and residential property sectors. The hospitality sector should recover in due course, but only once vaccinations have achieved critical mass. Here at home, Eskom was in the news all week long, first for firing its Chief Procurement Officer Solly Chitangano for misconduct, then for dismissing charges of racism against its CEO Andre de Ruyter, and finally for load shedding, which lasted for most of the week. De Ruyter also announced that there had been massive corruption and mismanagement in the construction of the Kusile power station, which will now only be fully operational in 2 years' time. As of Friday night, nearly 1.7 million South Africans had tested positive for COVID-19. 67 people died due to the virus on Friday, which brings the death toll to date to 56,832. Nearly half of all active cases are in Gauteng, with the Northern Cape, Free State and Northwest the other provinces with big active caseloads. 66,000 people were vaccinated on Friday, and nearly 1.3 million have now received at least one dose. Of these, 480,000 are fully vaccinated. Unemployment reached a new high in the first quarter, and producer price inflation soared in April. Our trade surplus shrank in April, but by much less than expected. The leading indicator foretells strong economic growth this year, and the Minister of Public Enterprises has vowed not to bail out SAA again. SARS is investigating the taxation of cryptocurrencies, and there are rumors that government is about to throw in the towel on e-tolls. And finally, the Gauteng government has paid two companies more than 16 million rand to disburse COVID relief funds worth just over 13 million rand to sportspeople and artists. According to the narrow official definition, 7.2 million South Africans, or 32.6% of the labour force, were unemployed in the first quarter. This is the highest rate in the world for a non-failed state, and a national disgrace. The picture gets even bleaker if we add the 3.1 million people deemed as discouraged work seekers because they do not actively seek formal employment. If they are counted among the unemployed, the rate shoots up to 46.6%. Youth unemployment is the biggest single threat to our country's socio-economic stability. Millions of young people, many of whom are well educated, face going through life without a steady job. As a cynic once put it, they now have to choose between becoming professional revolutionaries or professional criminals. At the end of the first quarter, 3 out of 4 young South Africans were facing this stark choice. South Africa's continuing trade surplus is largely due to two factors: weak import demand and high prices for our exports. The rise in our export earnings can be attributed to high global prices, not exchange rate effects, since the rand has been strong over the past year. The two stars of the show have been precious metals, the red line, and other metals and minerals, the dark blue line. The individual commodities that stand out most are coal, iron ore, copper and platinum group metals. South Africa's agricultural sector is also benefiting from strong global demand. Exports, the dark blue bars, amounted to $2.9 billion in the first quarter, outstripping imports, the light blue bars, by $1.4 billion. The most valuable exports were citrus, table grapes, maize, wine, wool and deciduous fruit. Our biggest import items are currently rice, wheat, chicken, palm oil and sugar. The JSE seesawed this week, reaching an all-time high, but ending up only 0.44% higher for the week. Financials were the best performing sector. The bond market rallied strongly, as did the rand. Standard Bank expects strong first half results, and Absa might be getting out of the asset management business. Prosus continues to search for the next Tencent, and Shoprite has had enough of Nigeria. Foreign investors were net buyers of 3.1 billion rands worth of South African bonds this week, but sold more than 5.5 billion rands worth of shares. For the year to date, the JSE has seen an outflow of 17.4 billion rand, while the bond market has lost nearly 30 billion rand. The rand has been the best performing emerging market currency relative to the dollar for the past year, largely thanks to South Africa's large trade surplus. But, to paraphrase Aaron Levenstein, statistics are like bikinis. What they reveal is suggestive, but what they conceal is vital. This graph proves this point. Even though South Africa and Brazil have both enjoyed export booms, the real, the brown line, has appreciated far less against the dollar than the rand, the white line, over the past year. The hidden vital point is that South Africa's demand for imports remains weak because our domestic economy is stagnant. This week's renewed load shedding was unpleasant, but hardly a surprise. Despite valiant efforts to improve operational efficiency and rejuvenate our power stations, Eskom's energy availability factor has declined by a third over the past 20 years due to a failure to properly maintain existing plants and delays in bringing new capacity on stream. The lack of certainty over electricity supply explains why companies are reluctant to invest in new energy-intensive ventures like mines, smelters, and factories. We remain slightly underweight South African equities relative to our long-term strategic asset allocation. Domestic equities look cheap relative to offshore equities, both in developed markets and emerging markets, as well as relative to the JSE's own historical average price-to-earnings ratio. Despite the apparent value they offer, local equities remain hamstrung by the weak domestic economy and uncertainty over government's economic policy intentions. Despite the sharp recovery in the prices of some domestic listed property counters, we remain worried over the sector's long-term outlook and heavy debt burden. We therefore avoid property until the outlook changes materially. Domestic bonds remain our preferred local asset class. Yields remain highly attractive, and although we remain concerned over the long-term outlook for South Africa's government finances, we believe that a substantial risk premium is already factored into bond prices and yields. We prefer government inflation-linked bonds at the shorter end of the yield curve and nominal bonds higher up the curve. We are wary of corporate credit, however. It looks both risky and expensive. The Adviceworks asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworks financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.